Thanks for joining the Small Business Show, where you can learn something useful about small business accounting and finance that's going to make your business more profitable, sustainable, and fun. Are you ready? Let's get started. Have you ever wondered what your business is going to look like in 5 years? Or maybe an investor asks you when you can afford to hire the next employee. Maybe you just wonder that yourself. Today we're going to figure out exactly how to know the answers to these kinds of, let's call them what-if problems. What if I hire somebody? What if I buy a new office? What if I go into a different business? All those what-if problems can be answered by a financial model. So we're going to learn how to create a financial model that answers these questions. First, I want to talk about how is a financial model different from a business model? That's a really easy one, but it's also easy to get confused, right? A business model is something that describes your business in words. You can say what you sell, who you sell it to, how you sell it to make profit. That's a business model. You can say, I'm in the restaurant industry. I sell fast food, XYZ. A financial model is described in numbers. It's how much you will sell, how much you will charge, how fast inflation will take effect. So a numeric model, I call a financial model. We're going to build a spreadsheet today to show you a financial model. A business model is just something you can tell your investors about, or you can describe your company. So why is a financial model important? It really helps you forecast everything. It informs your decisions, lets you play those what-if games about your business to decide how to spend your time, how to spend your money. The financial model has 4 pieces of its cycle. Really important that you understand. You input assumptions, you project revenue, you calculate your costs and overhead, you show your profit and your break even. And if you get to this point and you say, hey, wait a minute, there's no profit, there's no break even, now you got to go back and change your input assumptions. So it's this virtuous cycle, this iterative process of assuming what you think is going to happen in the future, projecting the sales first, then calculating the costs and the profit from that level of sales, and adjusting your assumptions if you need to. A really nice cycle that's connected on both ends. The first thing you got to start with then is those assumptions. And the assumptions are big picture stuff, really important questions like, what drives your business? What products will you make and sell? How much does it cost you to make those products? What's your cost of goods sold? What's your overhead? And don't forget, what's your time worth, right? What do you want to take home at the end of the day? But the biggest one is the first one. What drives your business? And by that I mean, what activities are you doing now that are going to result in sales later? For example, Facebook advertising might drive clicks, which drives signups, which drives subscriptions, which drives dollars. It all starts with that Facebook advertising. And if you know that, then you can project how much Facebook advertising you're going to do and eventually how much money you're going to receive as sales or revenue. That's what kicks off a model, is understanding what activity you do and how much money or how many sales will result from that activity. I've got 3 detailed models that I'm happy to share with you. These are spreadsheets, a basic one, a detailed one, and a really technically correct one that goes by GAAP standards. You can use any one you want. You'll find the links below. Just download them. They're in Excel or Google Sheets, and follow along as we go through the rest of this. When you start a new model, you're starting either from a fresh spreadsheet or maybe one of my templates that I've given you. The first thing I like to do is start a tab called the Instructions tab. And on that, I keep all kinds of things about how to use the model, which things are variables, which things are assumptions, and which dates when did I update the model last, okay? The second tab is an Assumptions tab, and that's where you collect any variables, anything that might change over time, or anything that you want to use in that game of what if. So number of employees. And so you could say if number of employees is one of your variables, then later on you'll be able to say, what if I hire another employee? Or what's the rate of inflation? Or what's the cost per click for a Facebook ad? Those are great variables to have in your Assumptions tab. Finally, the third tab is a Model tab. It's the revenue model. Build out your simple cash basis model. I've invested in Facebook ads. I had this many clicks, I got this much revenue. And finally, you're using formulas in the cells there to drive the calculations. Remember, you're not just hard coding, you're not using a calculator, you're not writing this down on paper and then translating it into a spreadsheet. You're using the spreadsheet to get what you need done. Okay, across the top of any model is the timeline. I like to go by month, but you could go by quarter or even year. And then finally, top to bottom on the model is, it looks just like a P&L, a profit and loss statement, or an income statement. You've got revenue, cost of goods sold, overhead expenses, net profit, right? If you need help reading a revenue statement or forgotten what those are all about, please see one of my videos that is how to read a P&L. It'll make it really easy for you. And a financial model really is just a P&L in a spreadsheet that looks towards the future, right? A P&L out of your QuickBooks looks towards the past. Financial model looks towards the future. I like to summarize my P&L at the bottom. This is a little different than it comes out of QuickBooks, but in a model, I like to add a couple of lines at the bottom that say, what's this going to do to my cash balance in the bank? How much cash am I going to have left? If I invest this in Facebook ads and I make this much revenue and I spend this much on expenses, am I going to have more cash at the end of the month or less cash? And if you project for 6 or 8 months ahead or 5 or 6 years ahead, you can see what happens to your cash. You're either consistently profitable and you're making more money and cash is building up, or maybe you're consistently overspending and cash is cratering and even going negative. That's what's pretty cool about a financial model is it can show you doing poorly. It can show negative profits and negative cash in the bank, even though we know in reality that's not something that's easy to do, to have negative cash in the bank. Okay, so you finished with your model. You see that your cash in the bank is positive or negative. Review your results. Make sure that your business is right-sized, that you're covering your variable costs, that you're covering your total costs, that you set aside money for your own salary, and that your business is overall profitable, that you've got cash in the bank. If it's not, remember the virtuous cycle. Go back and change your assumptions. All right? Have fun playing What If. Grab one of my free spreadsheets to get yourself started. I'll see you next time. If you're enjoying this and learning something new about your business, please remember to leave some comments down below, hit subscribe, or send me an email, david@fusecfo.com. I look forward to hearing from you.